banking crisis is going to continue to pinch credit in the short term, whether we're buying a car or buying a house, to the business owner, to the real estate investor who wants to go purchase a property or do a development project. Credit is pinching, and that's the most important part of this conversation.
All right, we're back.
Let's do it again.
And we're talking about rates, but how they are being influenced by the Federal Reserve. So Federal Reserve made a decision, raised rates like a lot of people thought. And we're going to be talking about how that's going to affect, obviously, the economy and more specifically real estate. Lots of banks still kind of like failing, right? A lot of I'm seeing tweets all the time about this bank and this merger's not going well. There's a lot of uncertainty, which obviously is not great because it's hard to plan. Let's talk about this first image. Tell us what it is and why it's so significant in terms of what's going on right now.
First Republic went under, and we've had 3 major bank failures this year. Signature, Silicon Valley, and then First Republic. The New York Times published this graph, and it just blew my mind. Those 3 banks add up to the 25 banks we had fail in 2008 during the Great Recession, with WAMU being the biggest one there at $432 million. They adjusted this graph for inflation, and yet those 3 banks are bigger than the 25 previous ones. This should cause us a little bit of pause. I mean, we need to sit there and go, oh my goodness, like what's happening right now? And then how was JP Morgan allowed to take this down? So one thing that's kind of interesting when you look at this is JP Morgan Chase, by law, that was the bank who purchased First Republic. They would not have been allowed to buy First Republic because they'd own more than 10% of the total banking sector. However, when a bank fails, that law doesn't apply. So the FDIC, now their mandate is to sell it to the highest bidder who cost the FDIC the lowest amount. So basically, they ended up costing the FDIC about $13 billion in deposit funds. Now, it's not from the taxpayer, so everyone already pays that. That doesn't come directly from the taxpayer. It comes from the FDIC's Deposit Insurance Fund. But that $13 billion was less than the other 3 banks that made the bid. One of the other things to consider here is we all remember like Lehman Brothers as the big one. So Lehman Brothers and Bear Stearns, Lehman Brothers represented $619 billion, and Bear Stearns represented $395 billion. So they were over $1 trillion worth of assets, and that was not brought up in this specific graph by the New York Times, because those were financial institutions and not banks. So in the last debacle, not only was it banks, but it was banks and financial institutions. So now Jamie Dimon comes out, JP Morgan Chase, and says, hey, banking looks stable. We're getting this under control. There's nothing to worry about. But JP Morgan Chase cut a sweetheart deal here. They got carve-outs to protect themselves of major losses. The second thing that they got inside of this deal was they were able to get high net worth and ultra high net worth individuals. So these 3 banks that went under catered to that segment. JP Morgan wanted to shift more into that market. They didn't even know until the last minute that they were the winning bid for it.
You know, one thing I wanted to bring up that a lot of people maybe don't think about day to day, right? Why is it a big deal if one bank buys another one? As a real estate investor, a lot of financing for projects comes from those regional and local banks, right? Smaller banks that can assess your development or your project and make a decision. When a big bank like JP Morgan gobbles up these smaller ones, you're getting less like one-to-one help, and you're getting more of like the system just checking off boxes. So you don't get that personalized relationship. It's pretty obvious everybody would want to work with a local bank or somebody they can talk to. And when you have these financial institutions or these smaller banks failing, you're getting less of that. Obviously, we're talking about 3 banks here in different parts of the country, but there's going to be a trickle effect. And you know what? I'm curious what your thoughts are. Do you think smaller bank failures are even being reported on? Like, is it even coming up to the news, because what my thought is, there's more happening behind the scenes that we can't see, because there was that other announcement, I think either this morning or yesterday, about a bank merger not happening, and that potentially is going to be signaling. Did you hear about this?
No.
There's a bank merger between, I'll have to look it up, but there's these two banks that were supposed to merge, and it's not going to happen. And then the stock fell of that bank. It's like a regional bank. And the question is why, right? And the suspicion is there's some behind the scenes turmoil happening. And again, this is the domino effect of the Fed raising rates over the course of the last year. And these are the things that we wouldn't be paying attention to as like everyday people, even as real estate investors, but it's absolutely going to affect us as individuals and investors.
It's totally starting to affect us because, like you were saying, but just to give specific examples, there are regional banks that specialize in farming. And so if you're doing a farming development, that's the bank you go to. You go to someone like JP Morgan Chase and say, hey, we're going to do a development for farming. They don't have a box for that. They don't have a checklist for that. They're also then going to increase your loan to value, amount down, possibly the credit. These regional banks and these smaller banks serve such a big part of our ecosystem here in the United States that causes commerce to spin quickly because of that specialization. When you see JP Morgan, now the largest bank in over 10% of the banking sector, gobbling up another bank, you need to be thinking in the back of your head, credit just got tighter. It's going to get pinched for a while. Who else is a problem? And where do I need to put my money to protect myself, both on the banking side and on the real estate side? So you should pause just for a second. Look around. How are my reserves? How's my bank? How are we doing? Cool. Now what's my way forward? What a lot of people want to do, though, in news like this, is they want to stop. They want to do nothing. When you do nothing, you're missing out on that future opportunity.
Number two, the second topic we're going to be talking about today is unlimited deposit insurance for everyone is basically what came out of this purchase. Tell me more about it.
A bunch of big banks got together. They loaned First Republic Bank $30 billion so that they would have deposits. JP Morgan Chase gave them a $70 billion line of credit. The Fed opened up their overnight window and said, hey, bring me your okay assets, not mark to market, aka maybe semi-toxic, and we'll give you full face value. 70% of the borrowing at the Fed overnight window was being done by First Republic. And so First Republic was essentially a zombie bank. They were just the walking dead because they were really being held up by that line of credit, the Fed, and the deposits from the other bank. Well, if all those deposits came in from other bank, do you not believe to yourself and everyone that's listening right now that there was some little deal in the background that said, hey, don't worry about those deposits, wink, wink, like we got you, which basically says we're insuring every deposit. And when Silicon Valley Bank went under, all the depositors were made whole. And now that First Republic has gone under, all of the depositors are being made whole. So the government hasn't come out and said this, but this is what's really happening. De facto, or just by not saying it, by their own actions, they are saying, you know what, that FDIC deposit limit of $250,000, it means nothing today. We're going to insure all deposits. And I'm going to be blunt, I don't like that. To the point where that's creating a sense of socialism for business and for high net worth individuals. Maybe you need to move your money around. Business, maybe you need to be a little smarter. So now the FDIC is coming out and saying, hey, we need new deposit limits, which I fully support. Let's go through deposit reforms. Maybe there's a higher amount that a business could pay, and then they could get insured up to $2 million or $5 million. Makes total sense. For the person, maybe they're still only insured up to $250, or maybe they could pay for a different level. So maybe for the whole system, deposit insurance goes up a little bit, but that protects all of us. That provides more stability. The sad part, it's going to take a full act of Congress to get that FDIC limit increased, when this probably should have been maybe tied to some type of an index or increasing over time instead of a one-time amount of $250,000.
You know, the FDIC thing is interesting because it's another, I'd say, layer of your money that you just don't ever think about. I remember growing up, it was $100,000, and now it's $250,000. And you're talking about it's going to go up to maybe $1 million or whatever it is. What that is confidence for you as a customer of a bank that if that bank fails, this amount of money up to this point will be covered.
100%.
Well, what's crazy is big part because of inflation, as well as just the success of a lot of businesses, there's a lot more money in these banks, like as an individual or business, than that limit can cover. You know what's interesting? I've never once ever heard anybody actually using that insurance. I'm sure it's happened, maybe, right? Yeah. But it never makes the news. It really is just like a comfort tool.
It's a comfort tool, right? But it's also part of it being there is because I think people don't understand our banking system.
Yeah.
Our banking system, so you go and put $500,000 in a bank, you're actually making a loan to the bank and allowing them to take risk with your deposit. And only $250,000 of that $500,000 is actually protected. But the average consumer doesn't understand that. What they believe is they're just shoving money in a safe account. Nor do I think the average consumer is actually qualified to open the bank's financials and then vet whether or not this is safe. And to be honest, I don't even know if most small businesses would be good at doing that. And those are the ones who may have deposits of $300,000, $400,000, $500,000. Because think about it, like, let's just say there's a little machine shop down the road. Let's say 50 employees work there. Well, 50 employees, that could be $250,000 a year in payroll or a month in payroll. Well, that means they probably have to have $600,000, $700,000, and that's just a little machine shop down the road. Is that owner like ready, willing, and able to go to B of A and say, hey, B of A, give me your financials, read through all their financials, and then digest them? It's not realistic.
I guess the unintended consequence of everything that's happening, just, you know, as an individual or business, you just care about your own money. Well, the amount that FDIC insurance covers that they actually have in the coffers is like a small percentage compared to all the deposits and all the banks in America. So that's why bank runs are dangerous, because they can't actually cover everybody. If they raise the amount, they don't actually have that money. So guess where that money comes from? They print it, right? Like they create it. And I guess the reason we geek out on this, you and I, because we're not like economists, is because it's going to create inflation. Yes. And inflation affects you as a person when you go out to shop for things, and it affects real estate. And so you could argue a lot of the house prices are the result of more money in the system. And this is another thing that could happen that would add more money into the system, like artificially, and potentially raise house prices. Not good for first-time home buyers, for people that, you know, right, just need to buy a home in general. And you think like if you as an owner, it's a good thing, but actually it's not a good thing, because if your house starts appreciating and you want to sell that, well, your new loan might be at a higher rate. I mean, like, I know it gets all kind of geeky, but this is a topic that you really have to break it down. But to put it simply, there's not enough money to cover everybody's money in banks, and the money they're going to create will affect everybody in a negative way.
If you want to see an example of exactly what you're talking about, doesn't matter what metro you live in. If you live in the Seattle metro, you know, you can go back and look at real estate prices on the residential side. Just go look at prices in 2018, 19, and 20. And then realize right as the lockdowns start to slow down, you see home price values explode. Well, why did that happen? Going back to exactly what you just said, money printer go brrr, and as more money flushed into the system, inflation, we saw it right there in housing prices. And if banks can't keep it under control, because we all have these magic, you know, Star Trek communicators, so these bank runs happen faster because we can move our money quicker.
In addition to obviously the house prices going up, what does this mean for real estate? You know, like what is the conditions that this is going to create?
What this means for real estate when we're talking about the banking crisis, and we're talking about these three major banks going under and JP Morgan gobbling them up, very simple. Credit conditions are going to continue to tighten. The average consumer won't see this. This is more for our investors and our commercial real estate people and our business owners. Those credit conditions have to tighten because as there becomes less banks and as they require more deposits, because now the FDIC is leaning on them, the Federal Reserve's leaning on them, they've got to increase their deposits. Well, if they increase their deposits, they have less money to loan out. And as the Federal Reserve raises interest rates, which they just did, which we're going to talk about more here in just a second, that makes everything more expensive. So on a percentage basis, all of a sudden you go to the real estate investor, and that debt is now 25 basis points or 0.25 more, just costs more. You go to a startup. A startup in tech survives on a future cash flow. They're betting on the future. Well, if they don't have revenue today, how many more people want to give them money when banks are falling apart in the background? So that liquidity dries up. The guy for the machine shop, his line of credit goes up a little bit. The person who wants to go purchase a car, the cost to purchase the car goes up a little bit. The credit card for the consumer goes up a little bit. So this type of bank collapse causes massive tightening throughout the whole system. And Jerome Powell at one point said that he believed the banking crisis was giving us about a 100 basis points or a 1% increase in the Fed fund rate. And so that's what we have to be considering, is that this means credit conditions are getting tighter today. So be prepared to do without as much credit as you had before. It also means they may come in and collateralize some of your credit too. You may have a line of credit and they say, okay, I need to collateralize that against a house or a piece of land or something of that nature, or they just may shrink it. Hey, Mr. Travis, this is Anton from JP Morgan Chase. I'm your preferred banker. Yeah, by the way, you used to have a $250,000 line of credit. Today we have to shrink it to $150,000. But I've always paid my bills on time. So whether that happens on a personal level or to a business or to the consumer trying to purchase even a car, that's what happens across this whole system.
Yeah, and to maybe even put it more simply for a buyer, for example, what are interest rates running at right now for like a mortgage?
6.75.
6.5. And we're going to be talking about this rate hike that the Fed just decided on, which is probably going to either keep it there or raise it.
Yep.
Just to give you an example, what's like the average house price right now in like the Seattle area for your starter home, like first time home buyer, would you say?
750,
right? And I don't know if you know these kind of numbers, even just ballpark it. At a 6 to 7% rate, what is like a mortgage going to be on something like that?
If it's like 750 and you put 5% down and it's 6.5, it's going to be like 5,600.
5,600. It's
with taxes and insurance.
Yeah. Right now it's double what it was a year ago.
It's so much more.
That's like kind of crazy.
It's not quite double. I think it's more like 35, 40%.
Okay, yeah.
I mean, if you go to anyone and say, hey, I expect you to pay 40% more for anything, you're going to be like, no. So what's happening with that specifically is you're having the people who have to buy or have to sell. This is their market. Okay. This isn't the I want to market. And it's hard to get people who are the seller who are locked in at a 3% mortgage to go, you know what, I'm going to trade up right now and go from a 3% to a 6%. Also, when rates were so low for so long, the thing to understand is we were essentially borrowing some borrowers from the future and we were sucking them into homes today, because normally that buyer would have had to have qualified for more, save for larger of a down payment. Instead, they were just able to qualify for that $950,000 home when they should have bought a $700,000 home.
And the reason I bring it up is because ultimately the decision to buy this house or that house or what can afford is the monthly payment.
Always.
And so it's forcing everybody into a stressful situation, right? Because you're paying more. Like you said, like, can you imagine if like the Honda you wanted to buy last year, but you had to wait because maybe, you know, timing wise is literally 30 to 40% more. It's hard to kind of swallow that.
Yes.
And that is the situation that we're currently in. So let's talk about what the Fed actually did. The rate hike, and where we go from here.
What the Fed did yesterday was they gave us a 25 basis point hike to the Fed fund rate. The Fed fund rate is the overnight rate that kind of affects everything. We've been talking about this for a while. So our prediction was that we were going to get 4 hikes, February, March, April, and May, and then probably done. Right now, it looks like we're spot on. The market this morning, when I looked, this is crazy. June expectations are 98% pause in rate hikes by the market, a 2% cut, and 0 for the rate increase. Jerome Powell, when he came out yesterday, he had the opportunity to be the hawk. We got easy Powell. We got the softer Jerome Powell. He basically said that, you know what, inflation is a little sticky. It's going to take longer to work through this, but he wasn't bearish, okay? And what's interesting is that he wasn't bearish, and even in his answers to the questions afterwards, he wasn't bearish. Now, he wasn't bullish by any means, so let's not oh, it's game on like Donkey Kong, it's 2021 all over again. But he didn't come in and say, this is not going to work. And I'm going to quote on this one. He said, we're going to need a few months of data to convince you we got it right. So what he's going to be looking at is he's going to be looking at this data, and specifically service X housing, so minus housing. He kept bringing up services inflation. And when we get that services inflation down, then the rest of the inflation will be coming under control, because you're seeing the housing inflation go down. Energy is doing fine, even though it ticked up a little bit. It actually didn't do what we thought it was going to do. So when OPEC said, hey, we're cutting 2 million barrels of production, all of us thought energy was going to spike. Energy went down, went up again, and has actually been trending down lately. The forecast is either going to be right or it's going to be wrong. And what I mean by that is inflation is going to slowly come down and be higher for longer, or inflation is going to come down quickly, which indicates we could have rate cuts in regards to this. What that means, though, is I'm sticking with our original thesis. I think we've hit the Fed fund terminal rate, and I think we're done with hikes. Right now, the bond market is betting that we will drop almost 100 basis points by the end of the year, and then another 50 to 75 in January of next year. One of the other interesting things, and this one I got to look down at my notes for, was Jay Powell talked about wage inflation. And this is a first time where he got real specific about a possible target. He said that he wanted wage inflation hitting a target of 3%, and currently it's sitting at 4 to 4.5%. And that this wage inflation target of 3% would indicate that we're on track for our long-term 2% inflation rate. Because the Fed has this competing dual mandate: get inflation at 2%, keep as many jobs in the economy as possible. So based on the data, the Federal Reserve is going to make some assumptions about where we're going. I believe they're going to come out and they're going to pause, and we're going to look at what happens over the next 60 days. And then I believe rates are going to float down later in 2023 or early 2024. I know other people disagree with this, but this is what my opinion of what the data is showing us. So what does that mean? What am I thinking as a real estate investor? I'm thinking right now that the crash bros, the housing bears, unfortunately are going to be wrong. They want to see a 2008 style crash because it makes a good YouTube headline. It makes a great TikTok headline. And yes, some markets have come down, but you're not going to see that fundamental implosion that we had before. And what's interesting is the Federal Reserve hiked the Fed funds rate, and the 10-year interest rate went down yesterday. And so what that means to us is it means mortgages, even though the Fed is hiked, is because the market is starting to feel like we're nearing the end. It means mortgages are going to start to float down. It means for the average buyer, it's going to be cheaper to buy a home. For the average investor, it's going to be cheaper. When does that happen? Probably happens over the next 6 to 9 months. So, like we said 2 episodes ago, we've seen peak interest rates. We've probably seen peak fear. Now, is there other events, black swans, things like that can come and get us? Absolutely. But this is going to increase demand as rates come down, and this low supply problem is not fixing itself. So expect, if it's not happening in your market yet, because it's happening here in the Seattle Metro, expect price increases to start happening again and the market to kind of go back to where it was. Now, it's not going to go back to 2021 and 2022 and 2020. Our real estate market's going to go back to 2017, 2018, which was still a phenomenal market, but don't expect 10, 20% appreciation. It's not going to happen. Right now in the Seattle Metro, I expect above average appreciation for 2023. We're already seeing it.
You know, we're talking about the Federal Reserve, and their goal or the mandate is the number one is to control inflation.
Yes.
They say 2% is a healthy inflation. We're nowhere near that. What are we? We're like at 5.5%, 6% right now, inflation-wise. We're like in the ballpark of that, right?
Yeah.
Which means to the person listening to this is that means your groceries are going to inflate by 5% a month, right? Give or take, or a year. I don't know exactly.
5% a year.
It's going to get more expensive.
Yes.
I know that when I go to a grocery store, I literally do a double take on my receipt and I've never had to worry about like how much my food costs.
Yes.
And that's crazy. And when it's happening at the grocery store, it's also happening to your car price, right? We're kind of in a weird spot with real estate, but everything in between. Let's talk about how all of this is affecting that and kind of where the Federal Reserve is, because ultimately that's going to affect real estate
Yes.
and home prices. And I think it's going to make things even more stressful.
So the Federal Reserve is pushing towards their long-term 2% targeting rate. One thing that they don't bring up very often, and we'll include a link to this in the comments, is in 2020, they started a thing called flexible average inflation targeting. FAT, I don't know, however you say that. It's a bad acronym. What that means, though, is it means that they can take inflation over a period of time and average it. And they actually, in their documents, they say that formal timeline is not defined. So let me give you an example. I think we're going to go through higher inflation for longer. And I think they're going to use this flexible average inflation targeting as one of their tools. The reason for that is onshoring. We're bringing production back. COVID destroyed our supply chain. We know in real estate and the housing sector, we're still behind from the Great Recession. So we have these inflationary items that are just naturally there. And what I believe is as they get services under control, the Fed will keep the Fed funds rate higher for longer. Okay, but I think they're going to bring it back down a little bit. And I think interest rates will then settle into the 5s. And then what they're going to say is inflation is going to be like 3.5. They're going to say, we have this tool. It's called flexible average inflation targeting. And so even though it's not 2 right now, it averaged over the last 7 years or 10 years or 5, whatever interval they choose, because they're the ones who wrote their own rule. They'll just pick one and say, you know what? Close enough, we did it. Congratulations, everyone. Then they'll pat themselves on the back. What this means as a consumer, we need to be mentally prepared for a little bit of higher inflation for longer. As a real estate investor, it's a buy signal. It's buy because I'm going to make a slightly better return higher for longer. It also means, yes, I need cash to be prudent and I need my reserves, but I can't be sitting on too much cash because inflation is going to be eating my nest egg as I sit there. This is one of those tools they don't talk about a lot, but be prepared for it to pop out when we don't think it's going to happen. All of a sudden, they're going to pop it right out of their tool bag and be like, you know what? We're close enough. Lastly, I want to kind of finish with just this part. Inflation is tricky to the human mind. It tricks you. And let me explain what I mean. If something was $100 last year and we had 6% inflation, now that is cost $106 this year for the exact same item. And so in our mind, we go, eggs is more expensive, car is more expensive, that house is more expensive. And we assume it's going to go back to the original $100 price. But that's not how inflation is measured. Inflation is measured over a 12-month period. And over that 12-month period, if the new shelf is 106 and prices went up 3%, so we're 109 and approximately 15 cents, it only went up 3%. But in our mind, we want to go back to the original $100. Well, they still have inflation under control if it only went up 3% due to the flexible average, targeting that they can do. But as a consumer, we want to go back to the 100. We're not going back to the 100. That's not happening. Those prices that home was, or that car was, or lumber, or your iPhone, is not coming back because inflation got so high that when they calm it down, it's not going back. So everyone, we got to figure out how to make a little more money. We got to figure out how to cut our expenses a little bit because it's just going to be more expensive. And especially because they're getting that wage inflation under control. When the Federal Reserve says wage inflation, it's what we all make. It's a fancy term for saying what you pay people. Nobody likes to talk about it. What they're saying is they need to pay people a little bit less to get that wage inflation under control. And that wage inflation is getting under control too. So just to kind of summarize what we went through again today, Benji, this banking crisis is probably getting close to being done. I know people are going to argue with me about that. But there's enough money out there, enough liquidity. And because the Fed is backstopping everyone, the worry is gone. They've put the fire out. 2, the banking crisis and the Federal Reserve raising interest rates is going to continue to pinch credit in the short term to the consumer, whether we're buying a car or buying a house, to the business owner who needs that line of credit, to the real estate investor who wants to go purchase a property or do a development project. Credit is pinching, and that's the most important part of this conversation. Even if you're not feeling it today, that one is coming. And then lastly, be prepared to live in a higher inflationary environment for longer, because the Fed has other tools that they haven't even popped out of their tool bag yet. That one's coming.